Is your portfolio ready for 2025? Dividend ETFs might just be the key to unlocking consistent income and impressive returns. But with nearly 3,000 dividend ETFs out there, finding the best ones can feel like a daunting task. Don't worry though, I've done the heavy lifting. In this video, I'll unveil the top 5 dividend ETFs you need to know about to maximize your gains and secure your financial future. To start, I've narrowed down the massive universe of nearly 3,000 dividend ETFs to just 13 standouts. Here's the criteria I use to separate the best from the rest. They need to have an expense ratio under 1%, a 5-year total return of at least 20%, at least $1 billion in assets, a dividend yield above 3%, a 3-year total return CAGR greater than 5%, and finally a 5-year total return CAGR over 10%. These rigorous requirements ensure we're looking at ETFs that not only pay attractive dividends, but also offer solid long-term growth potential. While these 13 ETFs already started out as strong contenders, I didn't stop there. I had to pinpoint the top 5 dividend ETFs for now and 2025. Investments that truly shine. To refine this elite list, I dug deeper, comparing each of the 13 ETFs and their dividend yields, expense ratios, total returns, and growth rates. The result? A selection of ETFs poised to deliver both income and growth in the years ahead. Of those 13 finalists, 5 ETFs come from the energy sector, but I've selected only the best in that category. Another 5 are in the large value space, where I've also picked the top performer. And the other 3 include a mid-cap blend ETF, a natural resources ETF, and a derivative income ETF to round out the final top 5. These choices offer a mix of high yield potential and growth opportunities, making them ideal picks for navigating today's market and preparing for 2025. All right, let's jump right into the top 5 dividend ETFs for now and 2025. Coming in at number 5 is DIVO, which is Amplify's CWP Enhanced Dividend Income ETF. Launched in 2016, DIVO is a derivative income ETF actively managed to include high-quality, large-cap companies with a history of dividend growth. It uses a tactical covered call strategy on individual stocks to enhance income and returns. Currently managing around $3.7 billion in assets with an average daily trading volume of 270,000 shares, DIVO offers a dividend yield of 4.38% and has an expense ratio of 0.56%. It has a beta of 0.75, meaning it's less volatile than the broader market. And just for context, a beta of 1 indicates market level volatility, while a beta below 1 indicates less risk, and a beta above 1 indicates higher risk. Looking at performance, DIVO boasts a 3-year total return of 31% and a 5-year return nearing 80%. When accounting for reinvested dividends, its 3-year CAGR is 9.45% and its 5-year CAGR is 12.25%. With 32 holdings, its top 10 make up roughly 50% of total assets, offering concentrated exposure to leading blue-chip firms. DIVO is an excellent choice for investors seeking stability and income. By focusing on high-quality companies and enhancing returns through a covered call strategy, it offers a balanced approach to dividend investing with downside protection and consistent payouts. At number 4, we have the wildly recognized SCHD, which is Schwab's U.S. Dividend Equity ETF. This fund, established in 2011, aims to track the Dow Jones U.S. Dividend 100 Index as closely as possible net of fees and expenses. SCHD boasts the largest assets under management on this list with a staggering $65 billion and averages over 10 million daily trades. Its dividend yield of 3.3% and an incredibly low expense ratio of 0.06% make it a standout for cost-conscious investors. With a beta of 0.87, it's slightly less volatile than the market. Performance-wise, SCHD delivers a 3-year total return of nearly 25%. And a 5-year return of 93%. Its 3-year CAGR is 7.3%, while its 5-year CAGR comes in at an impressive 13.9%. The fund holds 103 investments, with the top 10 accounting for 41% of assets, offering a strong yet diversified portfolio. SCHD is ideal for those seeking a blend of income and growth. Its focus on high-quality U.S. companies with strong fundamentals and solid dividend histories makes it a reliable pick for dividend-focused investors. Claiming the number 3 spot is URA, which is Global X's uranium ETF. Since its inception in 2010, URA has provided targeted exposure to companies in uranium mining and the production of nuclear components, catering to the growing demand for clean energy. With just under $4 billion in assets and a daily trading volume of 3 million shares, URA leads this list in dividend yield at 5.15%, though it carries a slightly higher expense ratio of 0.69 and a beta of 0.96, indicating near market volatility. URA's returns are noteworthy, with a 3-year total return of 43% and a 5-year return of an incredible 250%. Its 3-year CAGR is 8.59%, while the 5-year CAGR hits 28.31%. With 51 holdings, the top 10 make up 60% of the assets, including Cameco Corporation, which alone accounts for nearly 25%. If you're looking to invest in the future of clean energy, URA offers a compelling opportunity. Its targeted focus on uranium and nuclear energy positions it well to benefit from the global shift towards sustainability and carbon neutrality. Sliding into the number 2 spot is XMHQ, which is Invesco's S&P Mid-Cap Quality ETF. Launched in 2006, it's the oldest ETF on this list. The fund tracks the S&P Mid-Cap 400 Quality Index, focusing on mid-sized companies with strong financial metrics like return on equity, debt to equity, and earnings consistency. XMHQ manages $6 billion in assets and averages 360,000 daily trades, offering a dividend yield of 4.76% at a modest expense ratio of 0.25%. Its beta of 1.05 suggests slightly above market volatility. In terms of performance, XMHQ has a 3-year total return of 39% and a 5-year return of 127%. With the 3-year and 5-year CAGRs of 11.81% and 17.64% respectively. With 79 holdings, its top 10 account for 29% of the assets, predominantly in sectors like industrials, IT, consumer discretionary, and financials. XMHQ is perfect for investors seeking quality, mid-cap exposure with a focus on financially robust companies offering stability and upside potential. And taking the top spot is MLPX, Global X's MLP and Energy Infrastructure ETF. MLPX, launched in 2013, provides tax-efficient access to energy infrastructure companies, including master limited partnerships, known for their cash flow stability and required distributions to investors. Managing $2.25 billion in assets and averaging 200,000 daily trades, MLPX offers a dividend yield of 3.89%, an expense ratio of 0.5%, and it does have a higher beta of 1.23, reflecting its sector volatility. However, its returns are remarkable, with a 3-year total return of 105% and a 5-year return of 154%. Its 3-year CAGR is 25.28%, the highest on the list, and the 5-year CAGR is 20.51%. MLPX's 25 holdings are heavily concentrated, with the top 10 making up nearly 70% of assets. This ETF provides unparalleled exposure to essential infrastructure companies driving energy transportation and processing, making it a top choice for income-seeking investors looking to capitalize on the energy sector. There you have it, 5 of the best dividend ETFs for 2025, each offering unique advantages in yield, growth, and diversification. Which ETF is your favorite and why? Drop your thoughts in the comments. If you enjoyed this video, you can check out some of my other content linked here. As always, thanks for watching and hanging around till the end. Don't forget to like the video and subscribe so you don't miss out on any new content. Remember, I'm here to make content focused on your money and how to manage it best. See you in the next one.